In last one quarter, we've seen it all. First a gut-wrenching fall and then a majestic recovery. For the moment, looks like all the global concerns are behind us. A couple of weeks ago, the bulls were running for cover. Now, the bears are running for cover. So is the worst of the print behind us? What about global cues? And in this so-called market adjustment, where is value in this market? Which are some of the great businesses one should buy and where should one park their capital? Let's discuss all that and much more with someone who really is a true proponent of value stroke long-term investing, and that is Rajeev Thakkar. Fantastic to have you back and thank you for joining us.
Great to be here.
2016, I mean, we've seen hell and then we've seen heaven. What is the reality?
Well, you guys have all the excitement in the world. Your studios are where all the action is happening. At our end, it's as boring as watching grass grow. Our investments were the same in January when we last met, when all hell was breaking loose. And they are more or less the same 3 months later when we meet again. So nothing much has changed.
You've not changed anything, even though we've seen a so-called 180-degree turn.
Yeah, our portfolio has hardly changed through the turmoil.
Isn't that saying that you don't like to milk when opportunity is great?
Oh, if you are waiting with bated breath to see the next fact sheet and see what are the dramatic changes that are going to happen, it's absolutely boring. The most exciting thing that happens at our end is when we read a new annual report or we read a new biography or we discuss a business. That's all the excitement there is. Other than that, the easiest job in our office is that of the equity dealer, who probably on 17 days out of 20 working days in a month does not have anything to do in the dealing room.
So we'll talk about that exciting part, but right now let me address first the big picture. And the specifics of the big picture are, again, global in nature. For the moment, it appears that central bankers are unlikely to increase rates. B, the China concern is behind us, and now we have a bottom in place for commodities. So the OCD syndrome, which we were talking about, oil, China, and then debt, all those concerns have got addressed.
People are looking beyond those. I wouldn't say they are completely addressed. So the shale gas companies, which were distressed 3 months back, are not completely out of the woods. Their old hedges are expiring. They will have to sell incremental energy produced at the current market price, and they have debt, so they'll be distressed. Excess capacity in metals and all still prevails. So it's not that on the ground things have completely changed. What has changed is, one, that free fall kind of scenario where people were saying oil now at 35, now at 30, now 25, 20, 15, that kind of a thing has stopped. People are saying, okay, it won't go to zero. There'll be some price at which oil will sell or at which iron ore will sell. Also, people have stopped asking whether it's 2008 again.
Yeah. That conversation is over.
That conversation is over. So people are saying, okay, PSU banks have NPA problems, but how long will it take? 1 year, 2 years to clean up? How will the recovery process happen?
So it's a glass half full approach now.
Yes. So sentiment has changed, yes. Ground reality is more or less where it was. People are trying to unclog the system, be it asset sales happening all around or some of the defaulters trying to work out mechanisms to resolve their debt issues.
So the half glass full approach is that worst of the economic print, at least for the moment, is behind us, and global concerns for the moment they've got addressed. Let me pour in rest of the drink. And the environment around us, both locally and globally, is that interest rates surely and steadily are coming down.
True.
Growth will not be as great as what we've seen in last 5 years. Growth will come down, and there is a challenge. And even though central bankers are likely to print more money, the effectiveness of that is drying up. So we are in an environment where growth will be precious and liquidity will be surplus.
So we are in a low growth, low interest rate, low inflation environment. I think in such a scenario, surely nominal earnings growth will not be as great as we have seen in the past, but even a 10-12% kind of earnings growth for a couple of years is not that bad. of course, the last financial year has been a washout more or less in terms of earnings growth for the indices. But I think 16, 17 should be better than the year gone by.
Your largest holding for the longest time has been Google. And the challenge for the internet stocks is that valuations are coming down, and the so-called fashionable stock, the FANG stocks, Facebook has taken a knock off more than 20%, Amazon is out, Netflix is down more than 40-50% from the recent high. Google is the only one which is holding fort, and that remains to be our core holding. So if other internet stocks in the world are correcting, some would argue that it's a matter of time. Google will also fall down like there's no tomorrow.
Sure. So Amazon, wonderful business in terms of very charismatic leader, someone who's passionate and so on. Facebook again dominating in the social media space, but the starting valuations for both the companies were excessive. Netflix again, very high valuations. So Google headline price earning ratio would seem to be 30. If you remove cash, it would be about 25 times earnings. Again, even at 25 times earnings, you have $3.5 billion going into their other bets, so-called other bets, a huge amount of R&D spend, which happens, a business growing at very rapid rates. So 25 times kind of earnings, even before adjusting for all these expenses, is not that high a valuation. So even after the fall, among FANGs, Google is the cheapest. So
and when we say Google, you're talking about Alphabet here.
Alphabet, yeah. Yes.
So you're happy to keep Alphabet or Google as your top holding for another 2-3 years?
Longer, maybe.
Okay, so you're convinced that Google as a structural business is here to stay. So I'm going to step down and talk about some of your other key holdings. And you like private banks.
Yes.
And I think there's a very strong case that why one should like private banks. But given that environment, given the kind of environment we are in, when credit growth is expected to remain low, private sector still lacks the ability to start or commit fresh capital. Some would argue that private banks are only relying on one pony, and that one pony is retail.
So corporate loan demand will be constrained. So in a scenario where there is excess capacity, people will try and fill up the existing capacity before venturing out to borrow more. So that is true. However, if we look at the overall scenario where maybe 70% of the banking sector is with the public sector players, and where the public sector banks are constrained in terms of their existing lending, capital adequacy and so on, they are not going to be aggressive in terms of competing for fresh loans. So whatever credit demand is there, private sector banks have a possibility of growing at far in excess of the sector growth.
But do they have the ability to grow in an environment where growth otherwise is going to be challenging?
So overall loan growth may be lower than what we have seen in the heydays, but still they would notch up a very decent growth rate, and in fact their growth will contribute to the sector growth because public sector banks will have very flattish kind of growth numbers in terms of the loan book.
HDFC Bank is an expensive bank. Axis Bank is an expensive bank. So what is the meat in buying a good business at a price when it is not traditionally cheap? That's my definition.
Sure. So if you look at what Buffett has said with regard to banks and what various players have said, is that in banks, you surely don't want to go with the cheapest bank. You want to buy the best quality bank. And if you look at his holdings, Wells Fargo, again, a big position for Berkshire. Wells Fargo is not the cheapest bank around. It's the best quality bank. So in fact, he said that you can pay a expensive looking price for the best quality bank and get a good result, whereas if you buy the cheapest bank and where there's leverage and your lending may go bad, so you may end up with a very bad result. So in 2008 we have seen where people with huge number of years where they had a good track record of outperformance, in a single year they had excess weightage to some of the poorer credit names, and they lost everything.
So why have you decided to go ahead with HDFC Bank and not a Kotak Mahindra Bank or IndusInd Bank? Because Kotak Mahindra Bank and IndusInd Bank also, they pretty much have the same flavor, so to speak.
Sure. So I think it's a matter of individual judgment, preferences, and so on. Nothing against Kotak Bank or IndusInd Bank. We like the private sector banks in general. These are the three we have chosen, but maybe others also will do well.
Your comfort level is very high with them.
Yes.
Now, as we roll over from FY16 to FY17, one key factor or driving factor for the markets and for the economy will be how the pay commission would, dollars would be implemented, and the benefits which will come to the defense personnel. So we are looking at about 1,40,000 crores straight away coming in the hands of consumer, which automatically will have a multiplier effect in some of the discretionary, spending power. So how are we planning to capture that?
So the fact is well known, and I'm sure it will play out in some fashion. Predicting what the consumer will do with that extra money in the bank account is difficult to
But you have
predict.
to make assumptions.
One has to make assumptions. It's difficult to predict exactly what will happen. And secondly, in many cases, the starting valuations are not comfortable. So one obvious thing would be to, let's say, go out and buy FMCG stocks.
Which you are not doing.
But a so-called black swan has happened. You have a company like or an organization like Patanjali coming and disrupting a lot of the players. You have this whole e-commerce thing going on where a lot of consumers are going out and buying gadgets and various other things. So people are not spending so much on malls and spending money online. So a lot of changes in patterns are happening as to where the spend is going, and we are watching the space. In a lot of cases, the starting valuations are not giving comfort. We have Zydus Wellness in the consumption space, not linked to OROP or pay commission, but we feel they are well placed in their own artificial sweetener space. We have something like Mahindra Holidays, which would possibly benefit from more discretionary demand.
There is outright fear in pharmaceuticals. First, a couple of months ago, everyone thought nothing could go wrong. Now everyone is of the view that nothing could go right. You have a position in IPCA, and I'm sure that's been a painful position for you. Is the current market environment and the news flow forcing you to revisit pharma stocks? Is your conviction getting challenged?
So, in pharma, our stance is to buy after the pain rather than before the pain.
How do you judge that?
So, we buy once the warning letters come in.
So you bought IPCA after the...
We bought IPCA after the... so it's still above our purchase price in that sense. So if you look at the US market, which is the biggest export market for most pharmaceutical companies, there are two factors playing out over there. At one end, you have companies like Valiant and Turing and all that, which are getting a lot of bad press, and because of hiking up drug prices and all that. Even in the presidential election campaign, high drug prices are a campaign issue, and people are figuring out how to curb drug prices. So there is this big push towards generics. A lot of drugs will go off patent. That is at one end. At the other end, FDA has become very vigilant in terms of quality controls and processes that the Indian companies follow. So I think this is a phase where the men will be separated from the boys in the pharma space. So
what is so unique about IPCA? If I look at IPCA's business model, the margins are not the best in the industry. Their mainstay is paracetamol APIs, which again is a high volume but a low margin business. They don't have excellent value added products where they're right up in the supply chain. So at a time when just about every pharma stock has fallen 15, 20, even 50%, why have you decided to settle with IPCA?
So we are closely looking at a lot of pharma companies. Okay. IPCA is only about less than 2% of the overall portfolio. We are looking to create a basket of pharma stocks. This is not one stock with a large weightage, and
So pharma is there on your radar.
Pharma is there on our radar, and we are looking at businesses which go through this huge price corrections because of warning letters, and where we see that as a non-fatal problem, and where recovery should come in a year or two. So we are looking at those kind of
The school of
opportunities.
thought which you present is largely centered around buying monopolies, not investing. Buy companies which have great businesses, and those businesses cannot be displaced. So to a classic example here would be something like a Page Industries or an Eicher Motors or an Asian Paints. Whereas MOT investing has worked in the past and it may work in the future. My only challenge with MOT investing currently is that these stocks are very expensive. These businesses are ridiculously priced. So what are your thoughts there?
So we have stayed away from very high quality businesses where the valuation is priced to perfection or even higher than that.
So give me an example of a business which you want to buy, but you are not able to buy because of valuations.
You have mentioned some of those, Eicher Motors, Page Industries. So a lot of those businesses are there where valuations are not comfortable, and at a different valuation one would look at those.
A naysayer would say that there is deep value in infrastructure. Nothing is going right. Everything is going wrong. The problem is so scary now. Bankers are sitting on the boards and companies are being forced to liquidate some of their good assets. Is that an opportunity, or that is a realization of how hard the headlines are, how tough it is for some of the infra companies?
So I would be looking at people who are buying distressed assets rather than the sellers of distressed assets. So recently we have seen deals in the power space, airport space, cement space, where leveraged groups were forced to sell assets to other groups to create liquidity. So obviously where one seller is a distressed seller, the buyer is getting the assets at a low cost. So those buyers of assets would be in a better position, whereas some of these sellers, even though the starting valuation is low in terms of the nominal share price, or the share price may be far lower than the all-time highs, but most of the money that is realized from asset sales will go to the bankers. Ultimately, shareholders will not get anything significant. I would rather look at those buyers of assets
That's
who don't
interesting
have that
logic.
much
So don't buy
leverage.
companies which are selling good assets to reduce their debt because they're selling good businesses. In fact, buy those companies which are getting these assets cheap, because good assets, once they get transferred, they will benefit someone else.
True.
Where, to your mind, markets are still mispricing growth?
I think in the FMCG space where we discussed, I think people are still pricing in very high growth numbers. So in a scenario where inflation is low, I think a lot of pricing power may not be there as it used to be in the past. So I don't think markets are pricing in a 10-12% kind of growth. People are still looking at a 20% kind of growth, and if growth numbers were to be lower than what market expects, you could see some disappointment coming in over
And to
there.
flip it around, where our markets are slightly nervous about earnings recovery, and where do you think earnings recovery could surprise us?
So pharma, wherever there are these issues, I think people tend to write off companies, or people tend to become too pessimistic. So in pharma, maybe you could see opportunities coming in, especially companies which have had issues with FDA. In IT space, selectively, you could see companies benefiting from the overall recovery as and when it plays out in the developed countries. I think these two sectors one
So
could
what
look
is
at.
the right way to look at IT? You got Cognizant, which has issued a profit warning. You got Accenture, which has upgraded the guidance. They both are great companies. They both are big companies. So should one lean more towards what Cognizant has indicated, or should one buy into what Accenture has guided?
So in IT space, there's a churn going on. Cloud is a big thing. Social media is big. Analytics. There's a churn going on. The traditional application development maintenance space is not that high growth area anymore. So you have to look at people who will benefit from the shifts and trends. So Persistent is something that we own where we think they could benefit.
What do you make of the Persistent IBM deal?
I think it's a transformational deal for the Indian company, obviously, because they get experience of working with such a big partner, giving them ability to break through with some of the larger corporates down the line.
So you think that Persistent has got all the basic processes in place and they can scale up on the SMAC vertical?
I think so, yes.
What about the traditional business? Because one side the SMAC business is growing, traditional business seems to be slowing down, and which is hurting them now. Because if I look at the trajectory of Persistent, numbers have been slightly volatile. Whereas I'm with you when you say that SMAC and digital is a great opportunity, and that's an opportunity which is an exploding opportunity. Somehow the business or the earnings trajectory for Persistent has been slightly volatile.
So we are fine with lumpy earnings, and the model is such that you can't have smooth earnings coming quarter on quarter, and we are fine with that. Essentially, you have to look at it as an unfolding movie over the years rather than look at it quarter to quarter.
So typically you're a very patient investor. When you buy a stock, you have 3 to 5 year time frame minimum in your mind.
Yes.
When you look back in your investing career, which is one stock you regret selling early?
Selling early. I think Pidilite, Asian Paints. I think a lot of the high quality names, one was uncomfortable with valuations which were reached. They kept going up, earnings kept following.
And which is one stock you regret selling late?
Selling late. I don't think there's something which I held on for a long time. So obviously there are many investment mistakes, but those were essentially things which didn't work out as planned. So for example, many years back we used to own oil marketing companies when the oil prices were going up. And
a couple of years ago they were dirt cheap, trading below book.
True. So we were lucky to exit them at our cost price, although we would have sold even lower than cost price if things were not going as per plan. So I think the mistakes essentially have been in places where government is involved, either in dictating the price or in terms of policies and so on and so forth.
So you typically don't like businesses which are dependent on government?
Yes.
So you will not take a venture and you will not take a deep dive in a defense or in a railways, or for that matter any of the businesses which currently markets are excited about because there's a huge government push?
I would be very wary.
So you will not buy road companies, you will not buy infra companies which are making roads or are running BOT projects?
So we own one road company which in terms of financials is doing well, but in terms of headlines it scares us over the years.
There's no government domination there. Noida Toll Bridge, right?
Yeah.
There's no government domination there.
So periodically you have political parties wanting to make the road toll free, and you have agitations and things like that. So it scares you in the morning to read those headlines in the papers. It is making profits, it's paying out cash flow to the shareholders, but you keep having these things. So I think one is enough for us. Don't want too many of those.
So how would FY17 be different from FY16 from a market standpoint? FY16 frankly has been a lost year. It's been a lost year for long-term investors and medium-term investors because we started the year with a lot of hope and hype, and we are about to close the year on a dismal note.
I think people have got adjusted to the scenario that the times are tough. Growth rates will not be 20% kind of thing. But at the same time, people are looking out 1 year, 2 years from now. People are willing to maybe see through the weak earnings in maybe 1 or 2 quarters. But the grounds for recovery are being laid. Whether it's deleveraging, whether it's banks cleaning up their act, whether it's more purchasing power being placed in the hands of consumer through pay commission or OROP, whether it's capacity gradually filling up for people, government spend on infrastructure coming in. I think all the groundwork is being laid. Just have to wait for things to play out. And
really appreciate your time. Glad you could join us.
glad, yeah.
That's it on this edition of Market Makers. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.